Let me walk you through what's actually happening in this market right now. The rally we've experienced isn't some random speculation or hype-driven pump. This is fundamentally different from past silver spikes. The two previous major peaks in silver's history were in 1980 and 2011. Both of those rallies were largely driven by speculation. In 1980, it was the Hunt brothers trying to corner the market. In 2011, it was investment mania and inflation fears. Both crashed hard afterward. What we're seeing now in 2026 is completely different. This rally is being driven by a structural supply crisis that's been building for 5 consecutive years. According to the Silver Institute, the global silver market has been in deficit every single year since 2021. We're talking about cumulative deficits approaching 820 million ounces. That's nearly an entire year of global production just vanished from stockpiles. The industrial demand side of this equation is absolutely critical. Unlike gold, which is primarily an investment metal, over half of silver's annual consumption now comes from industrial applications. Solar panels alone consumed about 25% of global silver supply in 2024, and that number jumped even higher in 2025. Each solar panel requires approximately 20 grams of silver because of its unmatched electrical conductivity. There is no viable substitute that can match silver's performance in these applications. Electric vehicles are another massive demand driver. Each EV uses anywhere from 25 to 50 grams of silver in sensors, wiring, and power modules. The International Energy Agency estimates that by 2030, solar and EV sectors alone will consume half of global silver output. We're also seeing surging demand from AI data centers, advanced semiconductors, and medical applications. Now here's where the supply side gets really interesting. China controls between 60 and 70% of the world's refined silver supply. On January 1, 2026, China implemented new export restrictions on refined silver. Only large state-approved companies with annual production capacity of at least 80 tons can now export silver, and only after obtaining special government licenses. This effectively blocks hundreds of smaller exporters who previously served global markets. China is weaponizing their silver supply the same way they did with rare earth metals. Meanwhile, inventories on the COMEX and London Metal Exchange have collapsed to historic lows. We're talking about drawdowns of 70% over 5 years on the COMEX. These are good delivery bars, the physical metal that backs the paper markets, and they're disappearing at an alarming rate. So with all these bullish fundamentals, why am I warning about a pullback at $98? Let me explain the technical and structural reasons. First, we need to talk about what happened in late December 2025. On December 26th, the CME Group, which operates the COMEX Futures Exchange, dropped a bombshell. They released Advisory Number 25-393, announcing a massive increase in margin requirements for silver futures. The initial margin jumped from $22,000 to $25,000 per 5,000-ounce contract. That's a 13.6% increase in the capital required to hold a position. Then, just days later on December 31st, they raised margins again. Within 1 week, we saw back-to-back margin hikes. What does this mean? When margins increase, traders who are using leverage are forced to either post more cash or liquidate their positions. If you can't meet the new margin requirements, your broker closes your position, forcing you to sell. This creates immediate selling pressure regardless of the underlying fundamentals. The result was predictable. Silver plunged nearly 11% on December 29th, dropping from highs around $84 down to the low 70s in a single session. We saw similar volatility in early January with wild swings of 5 to 8% in single trading days. This is exactly what happened in 2011 when the CME raised silver margins 5 times in 9 days, causing a 30% crash. Now, as of January 13, 2026, the CME announced they're changing their entire methodology for setting margins on precious metals. Instead of fixed dollar amounts, margins will now be set as a percentage of contract value. For silver, they've set it at 9%. This means as silver prices rise, the margin requirements automatically increase proportionally. Here's what this means for the $98 level. At $98 per ounce, a 5,000-ounce silver contract would be worth $490,000. At 9% margins, that's over $44,000 required per contract. Compare that to when silver was at $60 earlier in 2025. Same contract size would have been worth $300,000 with margins around $27,000. The higher silver goes, the more capital is required, and the more leverage positions get flushed out. But it's not just the CME creating problems. We need to look at the technical picture. Silver's 14-day relative strength index has been above 70 for weeks. An RSI above 70 indicates overbought conditions, meaning too many people bought too quickly. This is a classic setup for a correction. We're seeing similar overbought readings across all time frames, weekly and monthly charts included. From a chart perspective, silver has been in a near parabolic move since mid-December. The metal gained over 25% in less than 3 weeks, racing from the low 60s to $84. That kind of vertical price action without any consolidation almost always leads to sharp pullbacks. Markets need to breathe. Even in the strongest bull markets, you need corrections to shake out weak hands and reset sentiment. Several analysts have identified key resistance zones that align with my $98 target. We've got Fibonacci extension levels clustering between $90 and $100. The 161.8% extension from the recent correction sits around $88. Multiple technical targets from different methodologies are converging in this $90 to $100 zone, creating a significant resistance cluster. Historically, corrections following major silver advances last anywhere from 2 to 5 months and retrace 30 to 50% of the preceding rally. If we see a 30% correction from $98, that would take us back to around $69. A 50% retracement would bring us down to around $58. These aren't random numbers. Look at the chart and you'll see these levels line up with previous support zones, the breakout level from the decades-long consolidation pattern, and key moving averages. The 200-day moving average is currently sitting around $40 to $41 and rising. This is a critical long-term trend indicator. As long as silver stays above this level during any correction, the bull market remains intact. But in the short term, we could easily see a pullback to the $70 to $75 range, which represents the December lows before the final explosive leg higher. Now let's talk about the macro environment, because this is crucial for understanding the timing and magnitude of any pullback. The Federal Reserve's policy path is creating uncertainty. Market participants entered 2026 expecting potential rate cuts, maybe 2 this year. However, recent statements from Fed officials suggest cuts might come later than expected, if at all. Philadelphia Fed President Anna Paulson indicated that further cuts may take time. This matters because lower interest rates are historically bullish for silver and precious metals. They reduce the opportunity cost of holding non-yielding assets like silver. If the Fed pauses or delays rate cuts, it removes a key tailwind that was supporting prices. We've already seen much of the expected easing cycle priced into current levels. If rate cut expectations fade further, we could see investment demand cool off. Central bank behavior is another factor. While central banks have been steady buyers of precious metals, particularly gold, there are signs that some have started trimming their reserves at higher price levels. China's central bank, which was a massive buyer through 2024 and early 2025, has slowed its pace of accumulation. If Chinese demand for gold cools significantly, the spillover effect could impact silver, especially given how stretched positioning has become in the futures markets. The US dollar index is also showing signs of stabilization after weakening through most of 2025. A stronger dollar typically creates headwinds for commodity prices, including silver. We saw this dynamic play out in mid-January when dollar strength coincided with silver pullbacks from the $95 highs. Let me address the geopolitical situation because it's been a major driver of safe haven demand. The recent surge to record highs was partly fueled by geopolitical tensions, particularly around Greenland. President Trump made statements about acquiring Greenland, even refusing to rule out military force initially. This created safe haven flows into precious metals. However, when Trump later walked back those statements and ruled out military force, we saw an immediate pullback in silver prices. The pattern is clear. Geopolitical risk premiums can inflate prices quickly, but they can deflate just as fast when tensions ease. We're in an environment where headline risk can create violent swings in both directions. While I'm not saying geopolitical risks are going away, we need to recognize that some of the fear premium currently baked into silver prices could evaporate if situations stabilize. Here's what really concerns me about the current setup. Sentiment has gotten extremely bullish. When you see analysts throwing out targets of $100 by March, $150, even $200 by mid-2026, it tells me we're reaching a point of maximum optimism. Don't get me wrong, I believe silver has massive upside potential over the next several years. But in the short term, when everyone is bullish and positioned the same way, that's when markets tend to correct. The futures market positioning data shows that managed money, hedge funds, and large speculators have built up massive long positions in silver. This is classic late-stage rally behavior. Everyone who wants to be long is already long. Where do new buyers come from to push prices higher in the immediate term? Meanwhile, any negative catalyst, whether it's a margin hike, a hawkish Fed statement, or easing geopolitical tensions, can trigger a wave of profit-taking. Let's talk about what the smart money is doing. While retail investors and smaller traders often chase prices higher, institutional players and sophisticated investors tend to take profits into strength. We've already seen evidence of this in late December when institutional desks locked in gains before year-end. If silver pushes to $98 or $100, you can bet that massive profit-taking will occur. Mining companies are another source of potential selling pressure that people overlook. Silver miners have been absolutely printing money at these price levels. Companies that were barely profitable at $30 silver are now generating massive cash flow at $90+. Many of these companies will look to lock in prices through hedging programs, selling forward production at these elevated levels. This creates additional supply pressure in the futures markets. I also want to address the physical versus paper market dynamic. Yes, the physical market remains incredibly tight. Yes, premiums on physical silver coins and bars are elevated. Yes, delivery times are extended. But here's the reality. The vast majority of price discovery still happens in the paper markets, the futures and options exchanges. When leveraged positions get liquidated due to margin requirements or stops getting hit, the paper price can disconnect sharply from physical fundamentals in the short term. We saw this exact pattern in December. Fundamentals didn't change. The supply deficit didn't magically disappear. China's export restrictions didn't reverse. But silver still dropped 11% in a day because of forced liquidation in the futures markets. The same thing can and likely will happen again when we approach major psychological levels like $100. The $98 to $100 zone represents a massive psychological barrier. Round numbers matter in markets. They act as natural profit-taking levels. Traders who bought at $50, $60, or $70 will be looking to take profits as we approach 100. Short-term traders will be booking gains. Algorithm-driven trading systems have sell orders clustered at these levels. The combination creates a powerful resistance zone. From a risk-reward perspective, chasing silver higher from current levels around $93 up to $98 doesn't make sense to me. You're buying into overbought conditions, right below major resistance, with margin requirements increasing and sentiment at extremes. Even if silver eventually goes to 120, 150 or higher over the next year or two, trying to capture those last few dollars up to 98 carries enormous risk of getting caught in a sharp correction. So what should you do? If you're holding physical silver that you bought at lower levels, congratulations, you're sitting on massive gains. Don't panic, sell into any correction. The long-term fundamentals remain incredibly bullish. This bull market has years to run based on the structural supply deficit and industrial demand growth. Physical holders should view any significant pullback as temporary noise. However, if you're trading silver futures or using leverage, you need to be extremely cautious here. Consider taking partial profits if you haven't already. Tighten your stop losses. Understand that a move from 93 to 98 is only about 5% upside, but a correction back to 75 is nearly 20% downside from current levels. The risk-reward is not in your favor for new positions. For those looking to add to positions or start new ones, patience will likely be rewarded. I would much rather be a buyer on a pullback to the $70 to $75 range than a buyer at 93 chasing toward 98. If we get a correction that takes silver back to $68 to $72, that's where I'd be looking to add aggressively. Those levels represent the previous resistance that became support, areas where the 50% retracement would land, and zones where the market previously showed strong buying interest. The key support levels to watch on any pullback include $80 as the first level, then $75, which represents recent consolidation, then $70 to $72, which was the launch point for the latest rally, and finally the critical $68 to $69 zone, which marks the previous all-time highs from decades ago and represents major long-term support. I want to emphasize something important. Nothing I'm saying contradicts the long-term bull case for silver. The fundamentals are extraordinary. We have 5 consecutive years of supply deficits with a 6th year projected for 2026. We have inelastic industrial demand that can't be easily substituted. We have geopolitical supply restrictions from China. We have depleted inventories at major exchanges. We have the green energy transition requiring massive amounts of silver for solar panels and EVs. All of this points to much higher silver prices over the coming years. Some analysts are projecting $150 to $200 by late 2026 or 2027, and I don't think those targets are unrealistic given the supply-demand imbalance. But markets don't move in straight lines. Even the strongest bull markets need corrections to consolidate gains and set up for the next leg higher. The corrections are actually healthy for the longevity of a bull market. They shake out weak hands, reset sentiment from extreme optimism back to neutral or cautious, allow moving averages to catch up to price, create new support levels, and give late buyers an opportunity to enter at better levels. Without corrections, you end up with bubbles that eventually burst violently. Look at what happened in late December as an example. Silver corrected from $84 to around $73, roughly 13%. That correction lasted only a few days. What happened next? Silver found support, stabilized, and then rallied to new all-time highs above $95. The correction didn't end the bull market. It created a launching pad for the next move higher. That's exactly how healthy bull markets operate. I expect we'll see a similar pattern at the $98 to $100 level. We'll likely see silver make a run at $100, possibly even tag it briefly. But the combination of technical resistance, margin requirement impacts, profit-taking, and overbought conditions will probably trigger a correction of 10 to 25%. That correction might last anywhere from a few weeks to a couple of months. Then, assuming the fundamental picture remains intact, which I expect it will, silver will find support, consolidate, build a new base, and eventually make another run higher. That's when the real fireworks could start. Because after consolidating these gains and shaking out excess speculation, silver will be positioned for a powerful move toward 120, 150, or even higher levels. The timeline matters too. We're in late January 2026 now. If silver reaches $98 to $100 in the next few weeks, we'd be looking at a February or March correction. This lines up with typical seasonal patterns where precious metals often see weakness in late winter before finding support and rallying through spring and summer. It also aligns with year-end rebalancing that's already occurred and the fading of some of the geopolitical risk premium. One more thing to consider is supply response. At $98 silver, you can bet that mining companies will be accelerating production plans. Previously uneconomic deposits will be reassessed, and recycling will increase significantly. Higher prices always bring out more supply eventually. While silver supply is relatively inelastic in the short term because most comes as a byproduct of other metals, sustained prices above $80 to $100 will absolutely incentivize increased production over the next year or two. The thrifting efforts from industrial users are also worth monitoring. Solar panel manufacturers and EV companies are aggressively working to reduce the amount of silver used per unit. While demand growth is still outpacing these efficiency gains, the pace of thrifting is accelerating due to soaring silver prices. Every dollar higher in silver price incentivizes more R&D spending to find ways to use less or find alternatives. This won't happen overnight, but it's a factor that could moderate demand growth rates over time. Here's my base case scenario for how this plays out. Silver likely makes a run at $98 to $100 over the next 2 to 4 weeks. We might see a brief spike above 100, possibly to 105 or even 110 if there's a momentum surge or short squeeze. But I expect that move to be short-lived. The combination of profit-taking, margin requirements, and technical resistance will trigger a correction. That correction likely takes us back to the $75 to $80 range initially, potentially as low as $68 to $72 if the selling intensifies. The correction probably lasts 4 to 8 weeks, possibly extending into March or April. During that time, we'll see lots of doom and gloom headlines, people questioning whether the rally is over, and weak hands getting shaken out. Then, assuming fundamentals remain solid, which I expect they will, silver finds support and begins building a new base. This consolidation phase might last through late spring into early summer. As silver demonstrates it can hold these higher levels, new buyers will enter, physical demand will absorb available supply, and we set up for the next major leg higher, later in 2026. My targets for the second half of 2026 are $120 to $150, and I think there's a legitimate shot at $175 to $200 by late 2026 or early 2027 if the supply situation continues deteriorating and investment demand accelerates. But we need this correction first to create a healthy foundation for those moves. So here's my action plan and what I'm doing personally. I'm holding my core physical silver position. I bought most of my silver years ago between $18 and $30, so I'm sitting on substantial gains. I have no intention of selling physical silver even if we see a sharp correction. This is a long-term strategic hold based on the fundamental thesis. For trading positions, I took profits on about 30% of my speculative positions when silver crossed $85. I'll look to take another 20 to 30% off if we reach $98 to $100. I'm keeping tight stops on remaining speculative positions around the $90 level. If we correct back to the $75 to $80 range, I'll start adding back to trading positions. If we get a deeper correction to 68 to 72, I'll add more aggressively. I'm also watching the gold to silver ratio closely. This ratio has been declining, meaning silver has been outperforming gold. Currently, we're around 70 ounces of silver to 1 ounce of gold. Historically, when this ratio gets down to the 60 to 65 range, silver tends to be relatively expensive compared to gold and due for a pause. If we see the ratio continue dropping rapidly, that would be another sign that silver is getting ahead of itself short-term. The key is to separate short-term trading from long-term investing. Short-term, I think we're due for a significant correction once we approach $98 to $100. Long-term, I remain incredibly bullish on silver and believe we're in the early stages of a multi-year bull market that could take silver to $200 or higher by 2027 or 2028. Don't let short-term volatility shake you out of long-term positions if you believe in the fundamental thesis. But also, don't blindly chase prices higher without considering the technical setup and risk-reward. The best investors know when to be aggressive and when to be patient. Right now at $93, approaching major resistance at 98 to 100 with overbought conditions and margin requirements increasing, patience is the better strategy. Let the market do its thing. Let the correction play out. Then look for your spot to enter or add when others are fearful and prices have reset to more attractive levels. I hope this gives you a comprehensive framework for thinking about silver's price action over the next few months. The bottom line is this. Expect a massive pullback when silver hits $98. It might be quick and violent, or it might be a slower grind lower. Either way, use it as an opportunity rather than something to fear. The secular bull market in silver is intact. The fundamentals are stronger than ever. But tactical timing matters, especially if you're using any leverage or trading around a core position. Be smart, be patient, and don't get caught up in the hype of round numbers and momentum. That's it for today. Let me know in the comments what you think about silver's price action and whether you're positioned for a potential pullback. Are you holding, selling, or waiting to buy the dip? I'd love to hear your perspective. If this video was helpful, make sure to hit that like button and subscribe for more silver market analysis. I'll see you in the next one. Stay safe out there.